The Fed hiked interest rates again, and the market responded by taking a bit of a dive, but we had a huge rally on Friday. I've got Riz with us, and we're going to talk about what in the world is going on in the market this week. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our weekly market recap webinar. Now, I know you may not have heard from him from a little while, but I promise you he's not dead. The man himself is back. Riz Memon, how you doing tonight, brother?
Thank you, Chris, for having me. I'm doing okay. Hope you're doing well as well.
We're doing good, but man, it has been a wild couple of weeks. You know, after trading sideways for a while, we had some big moves in the market, but honestly, we really haven't moved anywhere. And if you're interested in figuring out where the market's going to go next, make sure you do us a favor and slam that like and subscribe button. It really helps the channel grow. And also click that bell icon so you get notified every time we upload a new video. But yeah, Riz, the Fed upped the interest rates another 25 basis points, and market kind of tanked a little bit, and then a major rebound on Friday. What is going on? This market seems like it can't pick a direction.
Yeah, very, I would say finicky and tricky. We had, I think you can say we had that little bit of a double bottom there, like pretty much a perfect type of double bottom right at, what is that, 40, yeah, right there, 40, 45, 40, 50. Pretty much a classic textbook case of a double bottom. And you can even maybe see like kind of like a W, right? That's kind of the best way to I teach students to kind of look at it as a little bit like a W. There you go, Chris. Perfect. So I think from a technical standpoint, this is very bullish. Obviously, we had a very bullish. What was it like? I think like 2% day or something on Friday, if I'm not mistaken. I think it was like 2%, and it was a massive move. Obviously, we did have some data come in on Friday as well. Payrolls, sorry, employment numbers are looking very solid. Job growth is actually positive. We have the lowest unemployment numbers since 1960, I think. So it is wild. It's wild. We have GDP that's still positive 1 point something. Now, one thing I will notice that even though we have an economy that is continuing to add jobs, the actual reality is that compared to COVID and now, the new jobs added is about 1 million. So although there will be some PR spin with, the current administration saying, again, this isn't political, they will say, we've had about 12 million or something jobs added since 2020. The actual fact is that we are actually plus about 1.1 million or something if you factor in the jobs lost during COVID and the year, after that. So it is still positive. Don't get me wrong. It's just not as positive as you may think on first glance. Number two, even though the job numbers were very strong, we had, I think, maybe 200K or something added jobs into the economy. The number was actually revised lower. So it beat. You know what I mean? If you bring a number, they revised it lower. I think it was supposed to be 200 and something, and then they revised it to like 164,000 or something, and then it came in at 200. So it beat, but they were already lowered. So if you lower expectations and then you beat them a bit, are you really doing that great? I don't know, right? So I'm just shedding a little bit of light on the PR and kind of providing a little bit more context. Again, this isn't, I don't care about politics. I don't care who's in the White House. I don't care, about red, blue, white, yellow, green, doesn't matter. Okay. What I'm here to do is just talk about straight facts and sort of remove the veil, so to speak, on everything that's going on in all things economic, macro environment, geopolitics, and of course, markets. So we have had those things that I wanted to provide some context on. And last but not least, unemployment. This one is actually, clear cut and dry. It is phenomenal. One of the lowest unemployment numbers in, about 50, 55, maybe even 60 years, I believe. So it's in 1960, around there. So that is definitely significant. So one of the reasons, it hasn't been a classical cut and dry textbook recession is because we've had extremely low unemployment numbers. Like you cannot really realistically have a recession when unemployment's still high. In fact, if we look at wage growth has also been going up, meaning the average wage of people, the index on that is actually going up, meaning average wages are going up. When you have wages going up, that's not a sign of a recession. Okay, so there's many aspects where we haven't, if you look at just those, you'd be like, oh, this is a growing economy. What recession? You know, whereas if you look at from a plain GDP standpoint, last year we had two consecutive negative GDP prints, but then they were positive after that. So really you could make a case of us being in a recession, but for such a very short period of time, um, many pundits and economists and those on TV will tell you, well, depending on what their bias is and what their slant is, some will say, oh, the economy is just going to tank, just right around the corner, it's going to tank, and then the other side will tell you the economy hasn't been stronger, it's as strong as it's ever been, and it can continue to be stronger. So like the reality is very much in somewhere in between. And I know that's not the kind of thing we want to hear. That's not the thing where we want to be like, well, what do you mean it's somewhere in between? I thought it was great or I thought it was horrible. Like, this is unfortunately not how markets and economies work. They don't just swing from fully, you know, rip and roar and bubble, and they don't fully, depression. Like everyone just thinks boob or bust. Unfortunately, I'm not going to play to those sound bites and that kind of common verbiage that these people use to try and get clicks and views and bait people's emotions, right? That's not what I'm going to do, and that's not what I'm going to give into. So if you're very much looking for a sober, clear cut, uh, and nuanced take on the market, economics, and everything in between, then we are here to help you with that. Otherwise, there's plenty of places doom and gloom and the opposite side as well.
I think that's such a great insight because this is what you really come here for, guys. This is, no spin. Whereas, you like Riz was talking about, you can find plenty of places that'll spin it however you want. But you make a good point, Riz, that the numbers are looking really positive, especially with unemployment and things like that. But isn't this kind of opposite of what the Fed is trying to do with interest rates? I thought they were trying to cool the economy off. It sounds like the economy is pretty hot.
Fantastic question. And you would be absolutely right. They're trying to cool down the economy. They're trying to effectively put people out of work. And I've been saying that, I think, we're in May now. I've been saying that since probably mid last year. So wow, it's crazy. They've been trying, and they haven't been doing that good of a job. If you look at the results, and they're partly to blame, but in another way, it just goes to show you that the consumer, the economy is that strong. The average consumer is, you know, I would say had a lot of liquidity. Now, I will say that's been changing a bit. We've had people feeling the pinch now, and these things always take time, right? These things always take time. Before we know it, the next GDP print could be negative. Before we know it, the next employment numbers could be negative. Before we know it, we could see an uptick in unemployment, plus job growth could be negative. So these things can happen. It's always like this moving seesaw where it's not all static. So you're right. The Fed's been trying, they've been failing, and the market is, you can see, as Chris has drawn here with the two trend lines, the market has been moving upwards from the 3,500, 3,600 lows. So if you look at it from a clear technical standpoint, we are in an uptrend. Why? Because the market has realized, wait a second, the economy is more resilient and stronger than anticipated. The economy and the consumer is absorbing these rate hikes relatively well. Again, relatively well. If you think back, this is the highest rates we've had since 2006. The benchmark rates are now the highest since 2006. Like, many people I'm sure watching this webinar or watching this on YouTube were kids in 2006. I hadn't even started. I was a young tyke, 14 years old, and it was one of the greatest years of my life. Um, but that's another story. Uh, but here we are. Many people have not witnessed rates at this level ever in their life. There's kids walking around, you know, right now. They're kids going to school, maybe, grade 4, grade 5. They don't care about rates, but they haven't been alive long enough to even see rates at this point, right? So it's wild when I look at it from that context, but unbelievably so, the economy is still chugging along, it's still strong. And I always say, I'm not American. I will remind people I'm not American, but I always say, do not bet against America. Do not bet against capitalism. Do not do that. Okay. And again, people will say, oh, Riz, you're just a shill. You're pro American. I mean, again, we live in a global world, and there's nothing wrong with being pro American. There's nothing wrong with being pro capitalism. But I don't talk about it from a point of bias. I talk about it from a point of reality. Okay. To look at the long history of the financial markets, the long history of America, and I would say the Western world even. You cannot really fight against and go against and bet against that. And I want to make that point even more clear now, more than ever before, because especially on social media and all different social media outlets, and even in some media, mainstream media, there is a lot of doom and gloom. Oh, the US dollar is going to collapse. You would be surprised how many people reach out to me with this. Riz, the US dollar is going to collapse. Like, US dollar is going to be worth nothing. I need to get out. Well, okay, well, what are you going to do? Like, go into, you know, Venezuelan currency? Like, what's your plan here? Like, what are you going to do? Are you going to move to China? What are you going to do? Are you moving to Russia anytime soon? Like, what's the plan here if everything's going down? If that's the case, you best believe if America's going down, if the US dollar is going down, everything's crumbling. Everything's crumbling. Forget currency. You're going to be looking for the next place to find a piece of bread. That's the situation we're going to be in if you see a collapse of the US dollar. So really, when people say, Riz, the US dollar is going to collapse, it's going to be worth nothing, and these other currencies are going to replace it, and the other countries are going to be world leaders and superpowers, I'm like, okay, maybe. I don't know if it's going to happen in our time, and if it does, there's going to be way bigger problems than really worrying about the stock market, worrying about how much our dollar is worth, worrying about how much our dollar is worth compared to the Russian ruble, worrying about, who is in the White House, worrying about, all these things. It's going to be pointless. So then it blows my mind. People have these, kind of conjectures and these thoughts, but they won't think one step ahead. All I ask is people look at one step ahead. Okay, if this is your thesis, if this is your take, what is one step ahead of that? Total collapse? Okay, well, in that case, forget it. I'm not going to be here answering questions if that's the case. I'm not going to be here on this webinar. And Chris, I'm sure, will have other things to do as well. So always look one step ahead. This is a lesson in critical thinking. Okay, so I absolutely hate it. It just boils my blood when people go against really capitalism, America, whatever we want to call it. Okay, and I say this as a Canadian. Well, and if people, I'll kid you not, people are like, Riz, you're just pro-American. You Americans are so full of yourselves. I'm like, first of all, I'm not American. Okay. Second of all, I am one of the least, I would say, the most unbiased person you'll probably find when it comes to uh, politics, when it comes to geographical related, I would say, views. I'm not here to rag on a country. I'm also not here to boost a country. I'm here to really speak clearly, plainly on facts. And the US market is, of course, part and parcel of that, right? If America goes down, the U.S. markets goes down. Some of the greatest, best, amazing companies in the planet that we use products of and services of every single day, they go down too. I don't know if that's a word worth living in.
And you make a good point. There's a lot of doom and gloom out there. Like you said, you can find whatever you want on social media at this point, and there are people on both sides of the aisle who are just going crazy right now. And it's really not the best thing to be doing, to be spending your time worrying about things like this. Really, let's stay focused on what we've got in front of us. And like Riz was talking about, right now the market is starting to grind upwards. For the most part, unless we get a serious break and we break through this channel, we are grinding upwards at this point. So that would indicate that things are starting to recover. But let's take a look here at the breakdown of the S&P 500 and see what's going on. And huge move up on Friday with tech. I think we can mostly give thanks to Apple and earnings on that one. Communications is starting to curl up as well. And honestly, everything curled up on Friday because the market went just absolutely nuts. Like you were talking about, Riz, up about 2%. Is 1.85 for all of my semantics folks out there, but really starting to look up here. Consumer discretionary starting to curl up as well. The market bounced, and all of these things are starting to come back up, even with the First Republic collapse takeover. Even the financial sector was curling up on Friday. So everything was up, thanks, like I said, most part and parcel to Apple's earnings being so good.
Yeah, and it's interesting to see how we currently have energy and financials, utilities and healthcare underperforming and below that zero line, whereas everything else, even real estate and consumer staples, and of course consumer discretionary, uh, information, tech sector, all outperforming. Uh, the above that zero line there. So it's interesting to see kind of what was running well, which was financials were doing well earlier. Energy was dominating last year, and you could see how the top dogs aren't always the top dogs, right? So you could see that plain and clear year to date. The S&P 500 being up about nearly 7.5%. Quite a change from last year, right, where it was lower lows, quarter after quarter. So the market is actually positive. It may not seem like it to some, but it's actually positive. We had a nice recovery in many, many different stocks, and they're all from higher up than their lows.
Things definitely looking up right now for sure. Let's take a look here at some of our favorite commodities, and oil has been just giving us fits lately. We made that break here from this low right around 67-ish, 67.20. It looks like made a nice bounce up here to around the 81, $82 per barrel area, and then we kind of rejected off there, and we've been in a bit of a downtrend since then. Gold has been just going kind of nuts lately, but we seem to have cooled off. We came in, we got really close to this all-time high on gold on looks like Thursday here. Just about tapped it, 2049.92. The high is currently 2050.17. Didn't quite claim that and rejected pretty hard on Friday. So gold really holding right around this $2,000 per ounce area, which seems a little high to me. But Riz, what's going on with oil? I know we had some production cuts, but what is driving this price of oil down?
Yeah, production cuts are to kick in. We have actually seen, quite surprisingly, the commodities market, kind of do a little bit of a U-turn from the stock market, where I think it's predominantly thanks to asset class rotation. We have sector rotation, people getting out of different stocks like tech stocks into utilities, or getting out of financials and maybe into consumer discretionary or consumer staples. We have an asset class rotation, where maybe we see money coming out of commodities. In this case, gold, even though it had a little bit of a run up last week and a pullback to end off on Friday, it's still looking kind of bearish if you think about it, from that peak of 2050 per ounce. And same with oil. The last month or so, it's been a sort of a downtrend. We've seen that rotation out, and probably going into different asset classes, one of them being equities, right, which is stocks. So I'm kind of waiting to see if oil can kind of hold this level. I, believe it or not, really, really consider taking a long position on oil on Thursday, And right after Fed meeting was done, I'm like, okay, maybe we want to go long on Thursday via USO, which is the oil ETF that tracks the US price per barrel. And I was like, I was we had a few trades, we made a few moves. Obviously, it was a fantastic week, to be honest. I'm not gonna lie. Ever since I've been on, uh, it's actually been an amazing run of trades and amazing performance. I mean, I don't want to, give myself too much credit here, but I'm pleased with my performance in the market so far this year. Um, and I feel like, you know what, maybe I should have taken that oil trade. So that's one I didn't actually take. I kind of shied away from it, thinking, you know what, we've taken enough trades. I don't want to overtrade. Maybe I'm seeing something that's, you know, not viable. And of course, looking at back at it right now, it did have a nice move Thursday onwards to end Friday, but doesn't mean that's it. Doesn't mean the trade isn't viable. I really think maybe this week, right? When I'm looking at it right now, if I because we're recording this and we're doing this on a Sunday today, the futures markets are open and they're a little bit red, about 0.15%, let's say, tiny little bit red. Again, it's very early to say how tomorrow, Monday, will be. But maybe this setup plays and when we take a long position this week. So again, elite members will know live the moment I take any trade, and if it's this one, you will know.
It pays to be part of Elite, that's for sure. Let's take a look here at the bond yields and the current strength of the dollar. And, bond yields really have been kind of holding steady out ever since Silicon Valley and that whole debacle. Bond yields have been pretty consistent. I mean, we've been going up and down, from day to day, but for the most part, holding pretty solid here. And the dollar as well has really just been kind of going sideways. Everybody who says the sky is falling, it sure doesn't look like it to me. It looks like we're holding on pretty tight here in this area. And I mean, for me, this is not too fantastic. But Riz, are you seeing anything different?
Yeah. So one thing for context to understand about the U.S. dollar index is the strength of the US dollar actually is holding relatively well. It's some of the other currencies have gotten a little bit stronger overall. So we've seen the euro pick up. There was a time where the euro was pretty much on par with the US dollar. We've seen the US dollar to euro kind of firm up a bit. So again, the sky isn't collapsing. The US dollar isn't getting trashed. Like all that kind of doom and gloom hasn't really gone anywhere. And I just find it amazing how every single day, every week, every month, someone or the other is calling for the end of the world, but the world keeps continuing, and then they just keep on renewing their so-called timeline. They just keep extending the goalpost. I feel like that's not fair. And I remember I was having a chat with someone online on social media, and they were arguing with me. They're like, "Riz, this is going to collapse. This is going to go down." And I'm like, "Okay, let's have a bet. I'm not a betting man. I'm not a gambler. Uh, but okay, I'm willing to take those odds. So what will you do, if the US dollar doesn't collapse in the next year? I'm willing to bet that it is. If it does, if you think the US dollar will collapse, that means, you won't be able to buy lunch because you're going to have to, get mountains of cash to be able to get a loaf of bread. So here's what I'll do. I'll make sure I go out and treat you to the best lunch you've probably ever had in your life. Okay. Nope, didn't want to take that bet even. They didn't hear back from them. I'm like, you don't even have to put anything on the line. I'm the one who's putting everything on the line. I'm putting my reputation on the line. You're gonna get a nice meal out of it. But no, the problem is people don't want to put their money where their mouth is, and you know what? There's way too many people like that. And you'd be surprised how many people go on TV or are on social media yapping away, but they have no skin in the game. It blows my mind. Honestly, it's disgusting. But really, moving on, government bonds yields, as you're saying, is they're moving flat, relatively sideways. What's interesting is we had that 25 basis point hike on Wednesday, as you said, and what may happen now going forward in the next meeting, I think in a month or two, is the market is now predicting and projecting that the Fed will pause on the rate hikes. So we have had over a year of continuous rate hikes, one after the other, some being 50 basis points, some being 25 basis points. And now this would be the first potential pause. There's no guarantee. Something might change, but it might be that first potential pause in rate hikes. So we are at 5 to 5.25% benchmark interest rate in the U.S. So this might hold. Okay, and that's what we're seeing here with bond markets signaling that, and U.S. Treasury bond yields moving sideways.
Great insights as always. Let's switch back to the S&P 500 here. And now we've got some important dates this week in the market. And yes, we have some big numbers coming up. On Wednesday morning before the market open, we've got the inflation rate month on month and year on year, as well as the core inflation rate going to be announced. And it looks like they're forecasting things not moving up too much, or maybe even moving down here. So that's obviously going to be big if that happens. If it's the other way, that could obviously negatively affect the market. So we're going to be keeping an eye on that. And of course, I'm sure we'll have a play-by-play in Riz Elite if you're part of that, and we'll be watching that very carefully. Thursday, also PPI, which is the producer price index, also going to be reported as well, though not as closely followed as the CPI. The PPI is just as important, and Friday, nothing. This is a non-burger. But yeah, definitely some big numbers going to be reported that could really push the market one direction or another.
Yeah, definitely so, with Wednesday being the most important, like you said. Again, no one knows what's going to happen, but there are musings that maybe inflation is sticking around. We know one of the factors of inflation uh, can be excess demand for different products and services. And when does that happen? You see that with a strong consumer. You see that with a strong consumer that's made more money due to wage growth. Now, I won't go as far as to say that we're going to have inflation coming in hot, but maybe it's not as low as we want. Maybe it's, if you can see, 5% was the last time, and forecast is 4.9. But it's very, very minor, very, very minor. Now, if it comes in at, let's say, 4.8, 4.7, okay, there you go. I think the market, might be alluding to that with Friday's move. But on the flip side, you see 5.2, 5.1, 5.3. Oh boy, right? You're gonna see that. You're gonna see that catch the market off guard, and at that point, I would wager. You know what? We're gonna see a little bit of a pullback. So Wednesday is, to say the least, quite important. Okay, so we will be keeping an eye on that. Of course, 7:30 a.m. We'll be keeping everyone updated in Elite, and of course, that will define how we approach the market that day and that week, along with any trades as well.
All right. If you're here on the live call, go ahead and start posting your questions. While everybody's typing things up, Riz, obviously, we just talked about our major catalyst on Wednesday, but is there anything else that you're keeping an eye on this week that maybe we could chat about?
Yeah. So what's also continuing on is earnings week. Now, we've had the major core, large companies, Apple, uh, Microsoft, Google, Alphabet. We've had those big boys report already, but we do have some smaller companies. Some primarily in tech. Um, we would have PayPal, which is obviously a really bad word around our parts. Same with Palantir, that's also kind of a bad word. But for those that do watch those stocks or like those stocks, they report Monday after close. We also have Airbnb, which is another company, and that obviously tech related, and that's on Tuesday after close. Twilio is another one. TWLO. Uh, you know, we have that Oxy, which is Occidental Petroleum. Um, o yeah, OXY. Yep, perfect. This one also after Tuesday after close. So that'll be interesting to see. Again, Warren Buffett's a large shareholder in this, and they actually had the recent Berkshire Hathaway meeting on Saturday, and Warren Buffett said he's not looking to buy out Occidental like outright. He owns a large percentage, but he's not. He's gone on record and said he's not looking to buy it outright. Whereas there were kind of musings, because he owns such a large chunk, would he just buy the whole company outright? But he has said he's not. We actually have a big one on Wednesday, which is Disney on Wednesday after market close. So Disney is interesting. They had a solid Friday as well, and looking pretty good from a technical standpoint. Moving up slightly, in a little bit of a consolidation, but maybe you want to call it like a flag, bullish flag there. We have Thursday, Friday, nothing too, there's some companies, but mostly smaller, nothing too big. And that kind of rounds out the earnings season for the most part. But yeah, nothing else. I think we're going to keep an eye. I will say for those that are not in elite, for those that are also curious, I currently have two stock positions open, and I am approximately 88, let's say 90% or so cash position right now. And even with that said, I have been carrying a decent amount of cash, but of course I've been buying and selling and trading, stocks and options throughout the year. And it's been a great year so far for me, handily beating the S&P 500 um, by easily by about double at least. So I'm pleased with that. Again, using my strategy, my style of sustainable trading and investing. I'm not trying to, quadruple my account in a financial quarter or something. I'm dealing with large amounts of capital, so I don't need to chase that kind of gain with someone who was trading with 5 grand or 10 grand, right? That's not my game. And it's all about sustainable risk adjusted returns for me. And year after year after year after year, and this would be the 11th year, um, in a row of beating the markets. So that, my friends, is compounding and sustainable growth personified for you.
Very well said. That's definitely what we're all looking for. James has a question here. He says, all the talk of commercial real estate needing refinancing this year, do you see this as a real issue? And do you see this continuing to put pressure on the banking system? Riz, what are your thoughts on that?
Yeah, great question, James. So there's actually been a lot of, I would say, musings around the commercial real estate sector. And you are right. There is an issue there. There's a pocket of commercial real estate that is actually very, very high risk and very, very unpleasant. We've seen in the state of California, LA specifically, massive office buildings, massive amounts of office buildings, office space not being renewed, not being occupied. We've seen many of these office buildings that had traded hands and been bought or sold a few years ago for hundreds of millions, taking a massive haircut, losing their value by about 30-40%, just like that. And that's large drawdown. So anyone that tells you, what, real estate always goes up, no, especially not the case with commercial, especially in a post, COVID world where everything's changed. Work from home is actually a normal type of thing now. So there's definitely a pocket of commercial real estate that's very high, very undesirable. And guess what? As you said, James, there are a lot of banks exposed to that. Now we have seen a lot of the banks go, I would say the regional banks, uh, very much remain on shaky ground. And as you know, we've seen a few already go under, but that is primarily because they were overexposed to a certain type of clientele, certain type of customer, and because they didn't do a good enough job of hedging higher interest rates. And I did a whole video on that a couple months back. Um, so that was, I would say, pretty much management error on their part and absolute negligence on their part. One issue surrounding the commercial real estate kind of drawdown and a lack of demand for it, and it's sort of being like this black sheeps really, is the exposure to commercial real estate is vast, uh, and it's good thing that it's varied. So commercial real estate is varied. So there's some cities, some states, some regions where commercial real estate, although it's in the doldrums, you have all these strip malls and all these plazas and, uh, you know, kind of maybe just languishing. Rents are going down on them. There's many places vacant, but they're still there. They're not being bulldozed. They're not being completely shut down. It's not like that whole place turns into a crack den or something. But on the flip side, you have large commercial real estate that is undesirable. So you have this very, very big delta. Some that is completely vacant. It could in the form of office buildings, and that could range from the state of California, or you could have different office buildings in New York being vacant, or you can have run of the mill small town strip malls being vacant. So it's varied, and the exposure that the banks have is also varied. So it's a kind of a good thing where it's all going to come down to the banks, how they navigate this. From what I've seen, many of the banks have kind of put loss provisions already. They've kind of said that, okay, look, this is something we're going to lose money on, and they've already indicated that to the market via their earnings reports, via their projections, via their their holdings. So a little bit is already taken into account. So I don't think it's going to be like this. Because Silicon Valley went down and First Republic went down, it's going to now mean that JP Morgan is going to go down or Bank of America is going to go down, and commercial real estate is going to be the reason. I don't think it's going to be that concrete, because commercial real estate, as I've said, is very wide, very far reaching. Every bank has exposure to it in different shapes and forms and sizes, right? So I feel like the banking collapse, the banking uncertainty is still there. A lot of it has been contained, and the reason we've seen it very much so stay with the regional banks is because they were not properly capitalized, they were not properly managed, they did not properly hedge, and they were very much, I would say, tied to the hip with a certain demographic. So there's First Republic and Silicon Valley, they each had their own issues because they were very concentrated in a certain demographic. Silicon Valley Bank, for example, was very much giving out cheap loans and cheap money out to people in tech, to venture capital firms. And those very venture capital firms that they backed, that they funded, came in and did a run on the bank, right? So it's kind of like they gave out all this money, but the people that they gave all this money to were the very ones that perpetrated this large run on the banks, which effectively left them effectively negative on their books and not able to meet depositors' obligations. That's why the FDIC had to step in, right? So this is a long-winded answer. I hope it kind of sheds a little bit of light. I do not see commercial real estate uh, being the reason for major banks to go under or cause a wide systemic uh, issue. If there is a wide systemic issue that continues, it would be for other reasons as well. And we've seen that, it can kind of be like a snowball. If the moment we hear that, let's say, for example, Bank of America has a large amount of exposure to commercial real estate. I'm not saying they do, but let's just say they do, assuming. Then if the news comes out, then what do people do? Then we have people that have their money at Bank of America. Then they all start pulling it. They all start closing their accounts. They all start requiring withdrawals. They start pulling their investment. Then that perpetrates into an issue. So it's like the reason doesn't really matter. What matters is the after effect of what consumers and customers do that can bring back a negative situation. So what we also know is the FDIC is willing to come in and effectively guarantee all deposits, even though there is that 250K max. They've actually gone beyond that and said, you know what, we're still going to cover more than that, above and beyond. We saw that with Silicon Valley Bank plus FRC, which is First Republic. So that kind of risk that was there, well, people are going to lose all their money that were sitting in the bank. That's no longer there anymore. Hence why the markets absorbed this, and the financial markets have actually gone up since that regional banking fiasco.
Yeah, I mean, obviously, a lot of the events of 2020 kind of, perpetrated this. Everybody's working from home now for the most part. There's so much, shift in the way that we do work and the way that things are done in this economy. It's been quite a, I hate to use the term, but just a wild time to be alive, and it's really seeing a change in how things get done, and obviously, kind of the old ways, the old office buildings and things like that are becoming less needed, or at least less space is required. Whereas before, you would need to have huge offices in downtown areas that had typically ridiculously high real estate rates, and that's obviously starting to move into a different direction now. All right. Well, I'm not seeing any other questions, so I want to thank everybody coming out. Great questions tonight. Really appreciate it. And Riz, of course, we always appreciate your perspective. It's great having you back on the program.
Thank you, Chris. I'm hoping also next week is a good one where we, join you and see what the market has in store for us and provide a little bit more context, a little bit more reasonableness, I would say, in this world of very, very clickbaity hit pieces and, you know, left and right and no nuance whatsoever, which is kind of disheartening. But hey, someone's got to do that job. So, I'm sure we can come in and provide some sense in all this.
Absolutely. Couldn't have said it better myself. Hope everybody has a great rest of your weekend, and we'll see you in the market on Monday.